Hey everyone, welcome back to another episode of Stage Debate with Cost Seg Isaac. I'm Isaac Weimager, your host. I'm a cost segregation specialist, help people just like you offset their tax liabilities by doing cost segregation studies and leveraging depreciation. Today, we have some great guys, some rising stars in the industry. We have Chad Schieler, we have Nick Elder, we have Kevin Falk, all great friends and clients of mine that have some awesome advice to give you and share about putting together deals, exit strategies, and their journey. I'd like to give a shout out to our episode sponsor, a great friend of mine, Chaim Lefkowitz, B&L Appraisals, nationwide appraisal company. They're in with some of the biggest lenders. They have unmatched service. They do a spectacular job. They'll make sure that you're going to get every single penny's worth of your property and be able to leverage that as well. So these guys are definitely people you should reach out to. I want to thank our corporate sponsor, a great friend of mine, Michael Stern, Line Star Tax and LSD Consultants outsource CFO services in terms of what they're able to accomplish in complicated situations. They also have collection services, leasing services, so like they'll really get your property leased up. I've sent them guys. The results have been tremendous. These guys are revolutionizing the leasing and collections market. Reach out to Michael Stern and his team. Tune in, guys, for an awesome episode. Hey everyone, welcome back to another episode of Stage Debate. Today we have some fabulous panelists. We got Nick Elder, a good friend of mine. We got Chad Schieler, good friend and client of mine. Kevin Falk, great friend of mine, doing a lot of great stuff out there in the Northwest. Thank you guys for coming on today and making some time. I appreciate it. Thank you. Absolutely. Absolutely. So a 10-second background on these guys. These guys are rising stars in the industry, have been doing some fabulous things. I've been watching them. I've had the pleasure to work with some of them. So to you in the audience watching this, you guys tune in. These guys are going to have some great things to say, their take on the market, some current deals they're working on, their journey, and their strategy. So we're going to actually have the model of this podcast is the panelists introduce themselves. We'll start with Kevin. Kevin, give us a couple-minute rundown about how you got started in the industry, what your company name is, what your model is. Fill us in.
Yeah, first off, kick it off. Thanks for having me on here, Isaac. You're also a master in your space. We appreciate you having us on here, and Chad and Nick. It's an honor to be on here with you as well. So I'm Kevin Falk. I'm the principal of Nordic Partners Investments. My other partner, Jeff Duras, and also Ben Winters are not on this call. We're a three-headed monster here out of the Pacific Northwest, Seattle specific, but up and down from King County, Pierce County, Snohomish County, as we're expanding and growing. Was lucky enough to fall into real estate. I went to the University of Washington, got out in 2010 when the market was recovering, and just fell into real estate and loved it. And I got a really good piece of advice from Craig Wilson when I was at CBRE. He said, if you ever want to be a good broker or a good investor, learn how properties work first. So I went into property management and operations, probably one of the few or only property managers to become a syndicator. But I think it's the value that we're now providing to our clients as we understand how to operate these deals. That's what why we've been successful since we started. So we're a newer group. We've been around for 2.5 years, coming up on the 3-year mark, and we're massively expanding, and we'll be able to talk more on that later in the show. I'll let the other guys go.
Okay, thank you so much, Kevin. Chad, thank you so much for coming on the show. Fill us in. I know you're in Indiana, Midwest boy. I grew up in the Midwest in Michigan, so appreciate that, and give us a little background.
Yeah, thanks, Isaac. As well as what Kevin said, thanks for having us on today on the show. It's an honor to be part of this whole group here. And Isaac, you've been a great person to work with on our properties for cost seg studies. You helped us out quite a bit there, so thanks for that. My name is Chad Schieler out of Fishers, Indiana. So Midwest guy my whole life. Steady Eddie over here, as we call it. It's just a great market, great stable area. And my beginnings weren't really in real estate initially. I started in the credit card processing industry. Built a portfolio book of business there over about 18 years and decided back about 2017 to make a change into real estate. decided to spend 3 years overanalyzing everything, researching and having analysis paralysis, and finally bought a property in 2021, a little 4-unit property. Fast forward to today, we've done about 8 projects so far, closed to 300 doors between acquiring and developing one currently. Exited 3 deals so far with over average returns. Performer returns over that, pardon me. And now we're looking at some newer deals, over 100 plus units. We have one that will be on our contract here in a couple of days, about over 120 units. But yeah, it's going well. We're a team of 4 right now, Focus Capital. That's my story.
I love it. I love it. And I've seen some of the stuff that you've done, Chad, and over average returns, and I've seen that. And you've done good deals, and some of the big time brokers in the space are big fans of you for a good reason. You have another deal that you're raising for now, and that's probably going to go fast. So very, very happy for you. Keep doing good stuff. Nick, love what you guys are doing, you and team. And the reason why I say team is everybody's focused on team, but I feel like you guys put like an extra emphasis on the teamwork. Everything is team. You guys even go out to eat together. Everything is just team. And I love it. And you guys working on a deal now. You've closed deals. Give us a little bit of a background about you and your team.
Yeah, so first of all, Isaac, again, thanks for having me here. Kevin, Chad, honored to be joining you guys here. So a little bit about me. I think I've had a very atypical way of getting into real estate. I started my career in pharmaceutical sales. So 22 years old, my now business partner and one of my best friends hired me to move all the way from Pittsburgh to Denver to take over the Denver territory. So 22 years old, just moved out to Denver, not really knowing anybody, wanted to be in the mountains, wanted my life to change drastically, get out of Pittsburgh. But so I came out here and for a number of years continued to do pharma. And then at some point, 2019, I started investing in real estate. I actually started house hacking in Denver. So I did that twice. Started investing passively, and I just tried to save up as much money as I could from essentially limiting and almost eliminating my cost of living here. So that really kind of got my start in real estate. And then, pharma is a very turbulent industry. There's layoffs happening always, and I got pretty much lucky until 2022. My now friend and business partner, we were working at the same company. And we were in the car together. We just got screamed at by a doctor for God knows what. Said something wrong. But we found out that day that we were going to get laid off. And so we both decided we don't want to be in this anymore. We want to kind of create our own destiny. We love real estate. We love the process of rehabbing properties and working with others to do so. So we really launched formally Trinity Peak Partners at that point in time. So it was me, Joey Schneider, and his wife Meredith, who is now a retired eye physician. So she's done with that now, focused full time on this. So we closed on our first property on December 7th. Simultaneously, I also raised capital at a private equity firm here in Denver called Ironton Capital. So the first significant person I met in my life was Joey, and the second was my current mentor, Lon Welsh, who's the CEO of Ironton Capital. I've helped scale that company from about $30 to $80 million in AUM in the last year and a half or so. And then I'm doing a lot of my own deals as well with Joey and Meredith. We're primarily focused on value add and some development in Northwest Arkansas. So it's been a pretty quick, crazy journey in the last 6 months. Love what I'm doing, and it's just it's an honor to be here, and it's great to look forward to what the next 5 years look like. So I'm super excited.
Wow.
And,
Wow. That's pretty interesting.
Yeah.
And Nick, you live in Denver, correct?
Yeah, I'm in Denver.
And Joey's in Denver as well, or is in Arkansas?
No, they're in Denver. They're a little bit outside Denver. They got a nice little remote house up in the mountains.
Beautiful. I love it. I love it. Very, very cool. Let's jump into it. I want to start with Chad, and then we'll go to the rest. Chad, give us a little bit of a background of your model, your strategy, how you come to your conclusions. Obviously, you got the conservative guys, you got the aggressive guys. You see those equity multiples at 2.5, and then you see the equity multiples at 1.8. What goes into all these things? Your overall strategy?
Our strategy primarily is we acquire value add properties. That's our business plan right now. We do have one new development that we're doing in Fishers. We did that as a one-off with a development partner. But typically we look for properties that are undervalued, that are mismanaged, that are in great locations. So first of all, for us, we want great locations, great job growth, great population growth. great schools, low crime. That's our 4 metrics primarily. We're looking for stuff that we can easily, with low risk, accomplish a great business plan execution to enhance the NOI, whether it be through better operations or through unit upgrades, by increasing the rents on the units. We want to obviously see that the property has already underwent maybe some level of rent increase already, to where it has a great comp on the rent roll to be able to support those future rent increases on the rest of the property. But primarily that's what we focus on, and we're looking for properties within 2.5 hours radius of Indianapolis right now, where it's easy to manage. Indiana's a great state, great home base, great for businesses and schools. So we love where we live right now. And then going forward, we're still looking for those same value add properties. We're going to be going to Core Plus at some point here to, go up the ladder and acquire nicer deals and raise more equity for those. But looking for 100 plus unit properties right now, to where we can put on-site management there in place, great payroll, and have more efficiency and scale to manage better.
No, and I love that. It sounds like you self-manage. Sounds like that's why it has to be within 2.5 hours. And is that correct?
We don't today, but we're looking to bring PM in-house very soon.
Got it. And in terms of how you project, and you're more of a conservative guy, you're more of an aggressive guy, Chad?
Yeah, I'm very risk averse. People would say that's why I spent the first 4 deals using my own money first. I want to make my mistakes with my own money first before I raise capital for somebody else. And I think back to your whole equity multiple example, Isaac, of you could compare 2 deals, deal A and deal B, deal A having a multiple of 2.8 advertised, and deal B having 1.9. Well, the average guy is going to be like, well, I'm not a dummy, take the bigger one, higher number, right? But you have to look at who's the operating behind that and what assumptions did they use. There's so many levers to pull in this game. There's so many levers to pull. And if you're not underwriting a deal properly from the sponsor, you might get yourself in trouble there. And what we do is we try and put about 5 layers of cushion in a deal. So typically we'll have an extra buffer in the exit cap rate, right? Extra buffer in our vacancy, our rent growth assumptions, our CapEx budget. So if all these 5 things fail and we have to use a buffer up, we're to still meet the business plan and the pro forma. When I put numbers out on a pro forma, my thinking is that is a minimum we're going to hit. We'll do at least that good. So it's always an under promise, over deliver kind of thing. We don't want to be too conservative, right? You'll miss a deal, but have some sense there in your numbers, and don't overshoot your projections to where you can't sleep at night and you're just going to be killing yourself trying to make a number work.
I really love that. That talks to me a lot specifically. When I started out in my specific business of cost seg, and I was selling, so I was just trying to make everybody happy. And I was like, oh, I'll get you back a proposal back in 2 hours. And it took a day. They're like, hey, you said 2 hours. So then I started saying, hey, I'll get it back to you in 2 days. And I got it back in a day. And they were like, hey, you underpromise and overperform. You got it faster. I think underpromising and overperforming is what people want to see. I don't want you to promise me something going in thinking I'm going to get X, and I don't end up getting that. And I was at a meeting earlier this week with a guy, and he told me he syndicated 27 properties over his career. He's 65 years old now. And he said not once did he lose $1. And I said, but how's that possible? He's like, hey, sometimes I didn't end up gaining the guy $1. I never lost the principal of my investor's money. And he's like, that's because he's done something similar to what you have done, Chad, in terms of that buffer zone, where you're really promising the guy the minimum. You'll see with a lot of younger guys these days, and you know this yourself, they promise the maximum, and they're hoping for like a miracle that this and this happens. And believe it or not, back to the equity multiple idea, I look at OMs all the time, and they cross my desk all day. And you'll see from the younger guys, generally from the younger aggressive guys, you'll see the crazy equity multiples. When you come to the big sponsors, you will not see higher than, 1.8, 1.9, sometimes 2, but you won't see those crazy numbers because that's not their way of doing things, and they don't need to do those things because their investors know that they'll get them the 1.8, and if it ends up being 2.2, they'll get to 2.2. So people just try to convince people with their fabulous deal, but going that route obviously is the right way. Appreciate the insight. Nick, give us a little bit of insight in your overall strategy. I hope I didn't shoot myself in the leg and you're offering equity multiple of 3, you know what I mean?
I've got a 6 equity multiple. So yeah, I've got 10% rent growth assumption. It's going to be a great deal. Yeah,
Exactly.
so I think I'm probably, obviously much newer, I think, at this than Kevin and Chad as far as from an operational standpoint. At Trinity Peak Partners, I mean, we're focused on typical value add projects. We like Fayetteville, Arkansas, Springdale, Arkansas a lot. So we're focused there. I think we have a 25 unit in Fayetteville where we were able to vacate everybody who were on month to month, and we're ripping through the renovation. We really like a project like that, and I think we're looking at staying under probably the $5 million mark. That's usually south of 100 units. I think that market, and in a lot of markets, including my market in Denver here, there's a lot of opportunity if you're willing to work through a lot of the missing information and uncertainty in those deals. It's a lot of mom and pop owners, a lot of folks that have owned these properties for decades and they haven't touched them. The accounting is a little bit wishy-washy. You're not going to get a beautiful T12 handed to you in a beautiful Excel document. And so we really like those deals. They tend to be, I think, some of the best opportunities. And we bought that from the 25 unit we bought was exactly that. I think, Isaac, when we talked, we were under contract on an 81 unit that we ended up walking away from, but that's coming back in a different capacity, which is really interesting. But again, another owner who she 1031'd in October of 2021 and way overpaid. And, she doesn't want to lose her capital, but we might have an opportunity to partner with her, come in with equity, but at the original basis rather than going to get new debt on it. So it's a very interesting opportunity. Like I said, we like value add right now. We're about to go under contract on a 4-unit condo where we're going to renovate each and sell off individual units. And then it comes with a parcel of land that we're about to get at about a $150,000 discount, which we're going to develop 4 more townhomes on that with our partners down there. So I think we're evaluating, we really like value add where you're so much more in control of your destiny. I'm a little bit nervous on the development aspect because timing is everything. But I think it's going to be a good project. Most recently too at Ironton Capital, we launched 2 opportunity funds. We're about to launch a 3rd opportunity fund where we're actually funding the capital call on sponsor investments who need to either buy a new rate cap or fund the shortfall on the debt. And the projections on that look very lucrative. So we're focused on that at the Ironton Capital level. Trinity Peak Partners, we like the smaller value add deals that we can recycle capital a little bit more quickly than the larger ones.
I hear that. And a question before we get to Kevin, and Kevin, I'm very excited to hear from you as well. Something that you and Chad, you guys both mentioned some sort of development play. Chad, I'm more familiar with what he's doing in terms, he's done the classic also value add, but now he's doing a nice development project. But I think your core focus, Chad, tell me if I'm correct, is still the multifamily value add play. And Nick, you also mentioned that you're doing those condos, you're gonna renovate them and you're gonna sell them off. This might sound like an ignorant question, and it could be it is. I'm actually just very curious for myself and the audience. When you're focused on the classic multifamily value add play, it doesn't deviate from the plan at all and just gets you sidetracked by doing these development projects, or it actually works in sync and that's like not a distraction at all.
Yeah, I think for us, it works in sync. I mean, we're in growth mode, in scale mode, and we're not really interested in longer hold periods right now. We're interested in shorter projects where we can scale that capital a little bit more efficiently and quickly. I think we've got really good partners also in the Northwest Arkansas market. Our construction partner down there has done a lot of value add, multifamily value adds, but they've also done a lot of new development townhome projects. So it's going to be kind of a first at bat for us, but we've paired ourselves with a group that can make it happen, knows what they're doing. So it's really just about finding the right partners in there. And we're not looking to do like a 300 unit, build to rent new development project, but I think we can go through the smaller ones where it's not enough of a distraction from
Right.
what we're really looking to do.
And Chad, have you seen that? How's that working out with your overall game plan in terms of the development project you're focused on?
Really good. Yeah, we have done value add the first 7 projects, 8th being the new development project. And we made even more of those actually, because there's definitely a need for housing here. And this last project, we got a really awesome deal with the city of Fishers on some tax incentives, which brought our equity down to very, very low that we needed to raise. So if you look at equity needed versus the ROI on the promote, it was a great ratio there. So We'll do more of those. We'll do this one here as a test to see how it goes. But I'm very excited about some development in the future. I would say, out of all the arms that we could add to focused capital, development would probably be the next one.
Got it. So you think that if this deal goes well, it's potentially possible you'll spend and put a bigger focus on development in general.
Yeah, I do. Yeah, my latest hire actually came from a big developer. He was a land acquisitions person over there, director of that, and he loves development. So I have got a lot of experience, and that may be perfect for us going forward.
Very nice. So you got to be patient for development. Obviously, there's a lot of advantages. Create your own cap rate. There's no really limit, but there's a lot of red tape, and you got to be patient. It's not the quick value add in and out play. Kevin, let's hear a little bit about your model, your strategy. Obviously, you're in the Northwest. I know a lot of folks in the space, and I don't know so many folks in that space, in that area, that specific demographic. Overall strategy in terms of how you're scaling so fast. I know you don't have so many units, a little less than 100, but you're under contract on a few deals, and it's super duper possible that you're going to have close to 1,000 units by the end of the year. You're under contract in a bunch of deals. How's it working out with your capital partners? How are you structuring everything? Give us a good inside look.
Yeah, thanks, Isaac. You did a nice summary, and you asked like kind of what type of deals we do. We do good deals. We do value add. We do turnkey. So we just closed on a turnkey deal because we're basis guys. Right now is a great time to find good basis, no matter what market you're in. We foster similar strategies to Chad and Nick in the value add side. We look for 35% rent growth. We look for mom and pops that are unorganized. We're not here doing anything special or secret sauce. We're just replicating and we're executing. And so the big thing for us and the value that we're bringing to our clients is the in-house management. We've done that on our 6 projects. So we kicked this off, and I did something similar to Chad. We did my own first capital deal, did my own first project, and that's what's inspired Nordic Partners Investments. I met my partners. We were off to the races. So once we kind of proved out that first business model is rinse and repeat, and we did 5 other value add projects, all of which are going to be 100% stabilized come this July. 3 others are already done, 2 others finish, and then so we'll have 6 stabilized deals. During that time, we've been building up our investor base. We have patient capital. We're not here to just do deals. We're here to do good ones. We got Billy Bean baseball as our methodology, singles and doubles. You'll eventually hit triples and home runs. You just want to stay in the game, and like you guys said, you just don't want to lose money. I want to be that guy that did 27 deals and never lost investor capital. Right now we are those guys. We have 0 delinquency on our books in 2.5 years, not a penny. We don't have $1 cost overrun. We do guaranteed max prices with our contractors. That's another important thing I think is, as you're growing is now once you've kind of got an established track record and you've built out your business, we're not desperate for business either. We're not desperate for investors. We want the right investor. We want the right tenants. We want the right vendors. We want the right clients on the property management side. They can take up time and then distract you because now everything, is an opportunity cost. So for us, we're really trying to build out this solid fundamentals, efficiencies with business practices, which I can talk about. We've added in virtual assistants, which are incredible. I'm sure most people in the market know about it now, but we got folks overseas that can do work on the admin side for a fraction of the cost and actually do the work better. They're engineers, they're specialized, they're smart, they speak English. It's incredible. It's so that we're able to be versatile and hire paid and salary employees so you can bring that value to the client, but then back end the underlying work that needs to be done for a cheaper cost. And it really has made us efficient and versatile to grow this business. Like I said, we only have 80 units under syndication on our 6 deals. Different price point. That's $27 million in real estate in Seattle. But we're under contract on 180 units. We put out 3 LOIs today on 3 other projects, all 40 unit plus. We did 2 other 20 unit LOIs that'll be out in the next 48 hours. So on projections, and then yesterday we just signed a 180 unit management account. We just brought on 3 other management accounts for third-party P-Arm this year since we opened it in January. And then we just got a 500 unit management account. How do you get this much velocity to go 10x in your business? It all comes back to constant progress over time. So we're every day in the office, Monday through Sunday. Yeah, work-life balance, we have it, but we're grinders. And we're building a business now that now is getting traction. Why? Because we're doing the next right thing. We're hitting all our metrics. All of our clients are like, wow, these guys haven't missed a distribution. It's just everything is done and it's done right. You just don't have to force it. The business will grow, the capital will come, the investors will come, and then the reputation and track record follows. And it's just simple singles and doubles and quality wins that you start stacking on the board that then just eventually gets that peak for the business where you get that exponential growth. So yeah, we just got a 500 unit management portfolio that we're bringing over the next 6 months. We assigned 180 yesterday. We have about 50 right now. So we should have 700-ish units under third-party management and 300 under syndication by year's end. And the one thing I always like to say is the thing about the Pacific Northwest, it's contrarian. It's blue state. People talk about it. That's the political side. It's tough. It's not landlord-tenant friendly. But my investor is the best landlord-tenant law attorney in the state. We got her on retainer. I won't say her name, but she's incredible. And so when we run into those problems, we're ready. And that's what business is, right? That's what this whole thing is providing solutions to problems. And so we're just now in a place where we know they're going to come and we're ready for them. So that's where it's just like now you don't have to really worry. You're just in a stress-free zone. We're out just execution over and over.
I love it. Kevin, I love it. And something that stuck out for me specifically was the singles and doubles. Everybody comes into this space or any space and they just try to knock that grand slam day one. You hitting those singles and doubles, it's not as cool. Grand slam looks a lot cooler. If you want to be in for the long game and you want to return all investor capital and you want to do things right and you want to scale the right way, it's the singles and doubles. I love it. I love it. Chad, back to you. I want to focus a little more on the exit strategy a little bit. There's this concept out there, and it's possible you've never heard of it, and you don't do it. I'm curious to hear if you have or anybody else here has. When you go into a property and you start doing the classic value add play, you leave over some potential value add for the next buyer. Have you ever done that? What's your take on that?
Yes, I have before. I've done it both ways. I've done one where I've done the whole entire property value add, renovate all the units, and then sold it and, did the deal there. And then I've also done another property with the third that we did is we renovated half the units and it ended up being a lot better deal for me on the exit piece and the gain piece to only do half the units. And the reason why is if you're in a market to where you've got kind of like a ceiling as far as a price per door, you can sell the property for it. If you can still squeak out some good NOI, you won't get capped on the price per door. So on the second deal, we finished the whole entire property, we were capped. So we didn't get a very good cap rate in that deal. Well, then the next deal I learned, and we only finished half the units, and it was amazing. It's great.
Right. Interesting. So now I never heard of it, and obviously I'm not a syndicator and I'm not buying deals, but I'll invest here and there. And I saw it happen. I was like, well, why are you not renovating it? Then it hit me on the exit. It'd be beneficial. Kevin,
well, something else. You have to leave meeting both the next guy. You have to give them a reason to do their business plans and meet them
exactly.
Who's your buyer going to be? Right?
Exactly. Exactly. And people don't think so much about that. People don't think about the exit strategy as much. And I think there always has to be an exit strategy. Even if you plan on holding it for 5 to 10 years, what could the potential exit strategy be if I have to sell for whatever reason? I can't refi, especially in today's market. I think I'm going to refi. I can't refi. I have to sell. The loan's maturing. Nick, have you ever, what's your take on that? What's your take on leaving over some?
I love that. And honestly, I've looked at deals where I'm on the end of the buyer side of things, and I clearly can tell that somebody did implement that strategy, and it's particularly attractive to a buyer. So I agree. I think if you have a good sense of who your buyer is, I think you can really reverse engineer it and know exactly what your strategy and execution plan is going to be. So I'm going to agree with Chad. I love that. I guess a question I'd have for Chad is, On that, is there a minimum unit count? Like, what does that look like as far as size of property? Like, do you say, hey, if I'm over 50 units, this business plan makes sense. If I'm under 50 or if I'm under 30, we're just going to renovate the whole thing. I'm curious what your thought process is on that when you're looking at deals.
Yeah, I don't really think I have a hard and fast rule for you. The one that I'm referring to where we renovate half the units is only a 20 unit property. It's pretty small.
Yeah.
The ones we analyze right now, they're 100 plus unit properties, and we're in our model, we're baking in either 100% renovated units or 80% or 50%, kind of seeing where the numbers play out there. So one advantage there is if you have 50% of the units, you have to do a lot less capex, less money to raise, less risk, for the deal execution. And then as far as leaving meat in the bone for the next guy, every deal we look at right now, the question is always going to be, who is the buyer in this deal? Who's the buyer? Can we get this price per door in this market, in this area? Will we have enough buyer pool, right, to get a great price on this deal? But Nick, I don't think I really have a hard and fast rule for you, man. I'm sorry, but
no, that's okay. It's just good to know your thought process. Yeah.
Nothing wrong at all with doing all the units either. Nothing wrong with that. If you leave that meat in the bone for the next guy, or it's a turnkey deal, that's okay too.
Yeah, and I think that's our approach. I mean, we haven't gone full cycle on a multifamily value add yet, right? So I don't have that to speak on. Everything that we've done so far is much smaller. So we're always renovating it for the next buyer. We're not leaving any meat on the bone, for them to go ahead and finish the plan. I think we would probably definitely look at that at 100 units or more in our target markets, because I do think that does make sense and everybody wants to go bigger. But I think in the sub 100 units, especially in northwestern Arkansas, you do have the single buyer that could 1031 and trade up into what we are renovating, like a 25 unit, $3.5 million renovated asset. So that's who I think our buyer is in that market. We're not going to, renovate 13 of the 25 units and sell off to a syndicator. We'll finish up the project and then look to sell it. Or, worst case scenario, we'll be in a really good position to hold it for a little bit longer if we absolutely need to, and wait for the right buyer. So, I think, there's so many different, exit strategies that you can employ. But that's what we're focused on right now. But I do love Chad's strategy, especially with those larger properties. I think it makes a ton of sense.
What's interesting, man, is that wasn't my strategy at the very beginning. My plan was to actually renovate the whole entire property, hold it for like 4 years, and we keep them on about 20 months of ownership. And I realized that velocity of capital, if you graph it out, is so important to understand. And this is a deal I bought myself with my own money, and I was making like $5K a month of cash flow myself. I was like, this is an awesome deal. Like, why would I ever sell it? However, my money was locked up there, and I had a lot more deals I wanted to do. And for me to pull money out and recycle into something else to do a much bigger deal was much smarter for myself. And to have a third deal for our tracker too, that was important.
Yeah, and I think if you could provide quick liquidity to investors in a market like this, they're going to be happy. They're going to be happy investors, I think, at the end of the day. You'd love to hold on to it for 5-6 years and wait for that full realization of capital. But if you could get a quick win for investors and provide that liquidity in maybe a 2.5-3 year period, and then recycle the capital, I agree. I love it. So I love your approach, and I love that you accidentally stumbled upon it, and that you're running with it. So good stuff.
Kevin, what's your take on this? And do you have any specific plans for your exits eventually? Any specific approaches? Maybe something unique that goes on over there that doesn't happen on the East Coast or in the southeast?
Yeah, it's definitely different in the Pacific Northwest, and I don't think there's a right or wrong way of full execution plan. Selling off is still a continued value add. I agree that you probably want to do that with higher unit counts. We don't leave meat on the bone. We try to trim off as much of the fat as we can and continue to have a good deal when we're ready to sell and stabilize. We haven't had an exit yet, so I can't speak on that. But right now we're beating all of our projected rents. We're hitting higher cash on cash returns than expected for all of our clients. The cool thing about Seattle is the renter profile. So I'm not sure in Arkansas, and nothing against it, where you actually have your renters investing in your deals. But we do up here because we have so much capital, and the housing costs are so expensive in Seattle. So most of our tenants are making $100K plus a year. And so we actually have tenants in our deals that are investing in our next projects, which is kind of crazy to build out an investor pool with tenants that live in your buildings. But we've had that happen now twice. And so, for us in our exit strategy, it's market dependent. I mean, we're also listening to guys that have the bigger portfolios and kind of, keeping the ear close to the ground as we see what the, projected outlook is. And I think it's going to be pretty good for all of us here in the next 24 to 36 months for exits. Development is stopped, it's halted. And I get a lot of this data from my business partner, Jeff, who works on the Kidder Matthews team for development. It's like, at least for the Pacific Northwest, it's 15,000 units this year, 5,000 next year, and then it falls off a cliff. And then it's going to take about 20 to 25% rent growth to get developers back swinging hammers, at least up here. So that means that values and NOIs are going to go up, and that's going to be a good thing for us. So we're not, everything for us is patience. We don't have to do deals. We want to do the right deals, and we want to exit when it makes the most money for our investors. Investors come first at MPI over any time we do we make more money when we transact, period. But I would rather make sure that my investors are making their highest multiple and that we can find another up-leg deal to continue to roll their money, because I think, looking around this room or in this chat is some young guys. So, we aren't looking for the long hold that you get later on in your career. We're trying to do some deals. We're trying to get capital moving, that velocity going, but we're not going to just do it because, we need to do it to make our business grow. We're going to do it for our investors first. So that's very important. That's something we've learned and fostered at MPI is investors come first, tenants come second, vendor comes third, and Nordic Partners comes last. But if you keep that model and you make sure everybody's happy in that capital stack, of everyone, that ecosystem of business, and you have a good quality family of people that you take care of, like our properties that our tenants live at are communities. They like it. They feel safe. Even in Seattle, that isn't, I don't know really anywhere in America right now that's extremely safe, but in these larger metropolitan cities, there's crime. We pick good locations where tenants feel safe. We add additional layers of security. We light up our buildings. To date, we've never had a crime at a property. We've never had a break-in. These are important things now that makes it, guess what? That gets tenants to release. That gets tenants to tell friends to come rent from us. Our vacancy is basically zero. 1 or 2 weeks per deal that we have units on the market, and they're gone. Why? Quality management. People talk about it. That also brings in more management to our third-party management arm. I took on a small project for a broker here. He had 50% vacancy. He had a squatter in his building. We got the squatter out in 24 hours. We leased up the entire building from 50% to 100% leased in 3 weeks. He hadn't cash flowed in that deal for 3 years. It cash flows next quarter. And it's like, then that 6 unit, which might be small for our portfolio, just got us a 500 unit management account. Like, these are the things we do because we are all about operations that then get you a reputation that people talk about when you're not around, that then builds your business. And it comes from, like I said, then, now we have investors that are just natural organic growth. We got more investors coming in because they're like, wow, the MPI boys, they cut us a check every quarter, like they said. Wow, the MPI team sent me the monthly report on the 15th every single month since we started working with these guys. The metrics are all hitting there. Or actually, we do a 5% pref. It's nothing glamorous. That's because our price per doors are so expensive. Well, guess what? We've been hitting 7% cash on cash every single deal plus. And so the under promise, Chad, you said it, under promise, over deliver, be patient, work hard. And, it's very important. Then it goes to the vendors. We pay all of our invoices 30 days or less, non-negotiable, non-starter. Get your vendors paid. Follow up, get your Cosseg Isaacs some deals going.
Tell my clients to pay their vendors. Tell my clients to pay their rent. Chad pays his bills.
Yeah,
Anyways.
And then it goes all the way around. And then just be good quality people. Be fun. 100%. Be fun. Someone that someone wants to place capital with. Pick up your phone. Call back your investors quick. Shoot them a text message when they reach out. Be available. That grows a business. That grows a reputation where people want to invest capital. Because when I first started out in the business, I was like, how much money can I make? Terrible mindset. It's how much money you can find and how much money you can make for your investors. Everything else falls into place. Since we started doing that, since inception of this business, the growth is exponential.
Love it, Kevin, and I love the passion also. And I'm a passionate guy, and some people are like, they tell me all the time, like, Isaac, too passionate. I love what I do, and you love what you do, and keep it up. One last question for you guys before we get to the last segment of the show, and this is a point that you guys are going to smile about: skin in the game. So when it comes to a seasoned operator, and it comes to somebody who's been doing it for 20 years, and they have a reputation, they have good deals, they don't have to put their own money in the deal to raise capital. When it comes to a newbie, and even if it's a good deal, hey, who is this guy? Does he know what he's doing? Skin in the game shows something. And I know specifically that, Chad, you've put your own skin in the game, and obviously that's helped, and you've oversubscribed on deals fast. Let's try to make this point a little fast. I want to hear each of your takes on it just for a minute or two. Chad, what's your model with the skin in the game play?
Yeah, every deal we do, we put money in, at least 5%, 10% of equity. There's some deals that put in 28% of equity on some deals. I think that you have to put skin in the game for your investors to know that you're aligned with them, alongside them. However, it's also a delicate balance because as an operator syndicator, you can't have all of your capital in one deal, because you have to stretch your capital to do a lot more deals for these investors, and also maintain liquidity for the lenders and the banks, and really your own reserves. So you shouldn't put all your money in a deal. You shouldn't do that. You should put whatever lender requires, 10%, 5%, and call it a day, and satisfy your investors, as well as having enough capital reserves going forward.
No, 100%. Great to the point, enough to show your investors that you're serious about it and it's a good deal. You're not just raising it for the AC fee. You're not just raising it to get your management fee. You're raising it because you actually believe it's a good deal. Nick, what's your take on skin in the game?
Yeah, I mean, I think it's got to be a guarantee. I think you have to put skin in the game. Now, yes, it is very complicated if you're doing a lot of deals. One thing that I always want to make sure of is, if I mess up in this deal or if something goes wrong, can I provide a backstop with my own liquidity and not go do a capital call because I need, $40,000, $50,000. So if there's a reason, if we don't put skin in the game, it's because we want as much liquidity from that standpoint as possible. We're usually doing about 5 to 10% skin in the game. We're not doing massive $15, $20 million deals. We're doing smaller ones. Moving forward, I think we're moving a little bit away from doing more syndications, and we've got one capital partner moving forward. So it's going to allow us to have a little bit more of a competitive advantage in the marketplace. So from that standpoint, we'll have 100%, of our capital in the game, so that we can put even more from when we do go to syndicate much larger deals.
No, and I like that, and it really reminds me of the buffer zone. That having your own liquidity really gives you that buffer zone, like you said. If you need a little bit of capital, an extra expense, that you have something to back up on. Kevin, what's your quick take on skin in the game?
Must be sleeping easy there, Nick, with guaranteed capital. Must be nice. We're syndicating, so we have to do what the banks require us. If we've done all different types. We've done credit unions, we've done banks, we've done Freddie, agency, and so there's different requirements. So usually we're doing what the bank tells us, but it's usually 5 to 10%. I was a knucklehead growing up, and then finally got my life together. So I didn't start this business with a ton of capital. So you had to find strategic capital partners. We started this business with $2,000. We've not injected another penny into it of our own capital. And we have $27 million in real estate in 2.5 years. And it's, again, back to fundamentals, but it's also, we brought in the right JV partners that could bring in the capital to do the deals. We paid them handsomely. It was way for us to get continued business. And then we were, the beauty of entrepreneurship. I think the thing about it is when you're able to, because I had a $160K a year job, and we were working 2 jobs to grow the business. So we were doing that while we were syndicating. My salary from the business in 2.5 years has been less than $30,000 a year. Like I'm living like I'm homeless, and because I'm getting equity. So you kind of have to have the long term game to really look at it. It's like we leave all of our acquisition fees besides like, all right, I need a little bit of money to keep fuel in the tank. To pot, we're always making sure we're our operations. We have tons of runway to do the business. We have reserves to pay for the office for the next year. We have reserves to pay for all of our softwares that we have. It's like we are frugal so that we can do business. And it sounds like you guys are doing the same. So like we have enough to do earnest money on all these deals now that we have offers out on. And then we also have partners that can bring in the capital. And then now we have that investor base and some guys that can write some checks. So it's pretty cool to come from absolutely nothing to something.
I love it. And I definitely like what you said about you're making 160K a year and now you're making 30K a year. And obviously you're not really making 30K. You're making a lot more than that. You're building up a lot of equity. Guys, this was awesome. Really, really informative for myself, for the audience. Just the last couple minutes. Let's do it literally a minute a pop over here. Just one piece of advice that you would give to a newbie investor, something quick, something smart that you would, somebody starting off today, starting from his $160,000 job or starting from his $30 job an hour, whatever it is, and he's starting to syndicate, he's starting to get involved in real estate. What would you tell him? Chad, putting you on the spot.
I think the first thing is tell everyone what you're doing at first. I made the mistake of the first couple of years kind of flying under the radar and not raising capital. And I didn't raise capital about a year ago. And I missed a whole couple of years that people know what I was doing and following along and being primed. So that's probably one of the best skills to ever learn is raising capital. So start right away.
Got it. I like that. And was there any turning point in your career that really lit that fire under you to get you going? Something happened.
Yeah, how'd you know? we had a deal where we had to close on a property end of the year in 2022, and I had two of the partners, and we were $400K short at the table, and I had to write a check for $200,000 to get the close on time. I think our investor was happy, and that moment I knew I had to raise capital myself.
Wow. Thank you. Kevin, let's get to you. A piece of advice that you would give to a new guy starting and some turning point in your career that really lit that fire under you to be as passionate as you are today.
Yeah. People always ask, how did you start the business? How did you get it? Why are you successful? And I think people think too hard with anything, with investing, with being an entrepreneur, of like, how do I get started? It's really simple. It might sound crazy, but just start. Literally, just start. And then that constant progress over time, 1% gains per day, you start getting that momentum and you start getting that business that you've always wanted. Like I got a buddy of mine that exited a large tech company, and I went to him and I said, "Man, Eddie, how'd you start?" And the thing he said to me is, "Kevin, you just start." And that's what we did. We went out, we started the business. Like I said, some of the metrics, like $2,000, and we got an office now. We got 6 assets. We're trying to have 11 by the end of the year, and then I can't even tell how many we'll have with third-party management.
God willing. And is there anything that's happened that gave you that fire? Because obviously we see that you're all passionate. That gave you that Monday to Sunday blood in you.
Yeah, I've never really shared this out in public, but I put it on my sleeve these days. I was a junkie in my life. I had an alcohol problem, and I finally solved it. And when I started to solve that, I saw the correlation between the two. Of, Confucius says this is life is easy. It's man that makes it difficult. Business is easy. It's business owners that make it difficult. Sobriety is easy. It's Kevin that makes it difficult. So when you kind of like look at that and you have all this overlap in life, and the big thing between those two with living a quality life and then having a quality business, the biggest thing I would say to anybody is giving back to others, giving back to guys that are getting new to the space, spending that time to teach other people your successes, giving back to the community. We're a new group. But we're now actually, I don't want to take up too much time, but we're working with a group now, and we're trying to start Nordic Cares, because Seattle has a homeless problem. and we're trying to get together to help these ladies at Project Grace buy a building so we can get sex trafficked women off Aurora Avenue, which is a really big problem for us. And it's a really great way to just say, hey, you know, the folks that are investing with us, invest in the community. Because if we don't have the community that's around here, we have nothing to invest in. And so giving back to people and giving back to others is more important than how much money you're making in your business. I'll tell you that.
100%. Wow. Super impressive. And thanks for being vulnerable. That's impressive. I just got a newfound respect for you, Kevin, and keep up the great work. It's incredible.
Appreciate it, buddy.
In and off the court, on and off the court. So keep it up, man. Last but not least, Nick, thank you so much again for coming on. I tremendously respect you. What would you give? What piece of advice would you give to a new guy starting out in the real estate space, and some sort of aha moment, some lit that fire under you to just go strong, keep going at it day after day?
Yeah. First of all, Kevin, very respectable. Everything you just said. So that's awesome. And I live in Denver, so the homelessness problem is just terrible. It's getting bad. Us West Coast cities, it's just, it's rough. But, I think, and I relate a lot to Kevin's story. I used to make 150, 160,000. And when I switched over, I was making pretty much nothing, and I was living on what I had saved up. And I think you have to be willing to risk it all and experience having nothing before you get to really appreciate and get rewarded for having everything. I got friends that have just grown up living in a lavish house, and they've never had to experience anything like that. And I see where they're at now in their 30s. And then you see people that have been, at the very bottom, and now look at where they're at, And so I think you have to be willing to lose it all, risk it, and take risk in your own name, not somebody else's. Because you'll get credit for the reward on the back end whenever you do get to that point. I think also if you can find a way, if you're young, to latch onto a mentor who has had the experience and has been doing this for a long time. I mean, that's what's helped me fast forward maybe 5 to 10 years and avoid a lot of mistakes that I could have made just by surrounding myself with people that have 60 plus years of cumulative commercial real estate experience. So if you can find a way to latch yourself onto a mentor and be willing to potentially lose everything you have and risk as much as you can. I think that is, you got to be willing to, I think, go through those things and be okay with it and know that you can come out the other side. So that's advice that I would give, I think, to people starting out, young folks especially. I think the turning point for me was, I bought my first house with $10,000 down, and I sold it 5 years later and pretty much 12x'd my equity in Denver. And seeing what that has done has just kind of been life-changing. And it didn't start big. It wasn't like go big or go home. It was, I bought one house. I rented out 2 rooms. I sold it 5 years later. I didn't pay any taxes on it. I got a bunch of cash flow, and that was just with one house. And I think if you don't have to start big, you can start small. And that one house has kind of helped me give me my launch a little bit in real estate. So, don't be afraid to just take baby steps and get those singles and doubles, like Kevin was saying. Don't be afraid to go that route. You don't need the home run right from the start.
Wow. Love it. Wow, guys, Nick, Chad, Kevin, this was awesome. This was a good one. I appreciate so much you guys coming on. To the audience, to everybody listening, these guys are good. I filter out the good ones. I don't just take everybody on the podcast. So these guys are good. Check them out. They do nice deals. Get in touch with them. Hey, everyone. Thank you so much for tuning in to another episode of Stage Debate, the only podcast that is panel style. Drop a like, drop a follow, subscribe. You can find us on Apple Podcasts, Spotify, and YouTube. Thanks for tuning in. Have a wonderful day.